Good afternoon, and thank you for joining us today. Today's presentation is on navigating sales tax compliance in e-commerce. Your presenters today are Brian Greer and Jeff Meggs from Tax Connects. Just a few housekeeping items before we get started here. All your lines are on mute and will remain on mute throughout the webinar. There will be 3 polling questions throughout the presentation. And as a reminder, this webinar is not eligible for CPE credit. We are providing a copy of the slides, which can be found in the handout section of the GoToWebinar panel, and a recording will be emailed out later this week. If you have any questions, please submit them within the questions box on the GoToWebinar panel. There should be time for a Q&A at the end of today's session, but we can also take questions as they come in, so please feel free to submit your questions at any point. We'll do our best to get to all the questions, but if there's anything that should be answered in private or we can't get to them all, we'll respond to those afterwards via email. Again, thanks for joining us, and with that, I'll pass it over to Brian.
Hey, good afternoon, everybody. Thank you, Kate. This is Brian here at Tax Connects, and I'm joined by one of my partners, as Kate mentioned, Jeff Meggs. So excited that you guys are here with us today. Topic that we end up speaking with a lot of e-commerce related businesses, both specifically, or I should say solely e-commerce related businesses, and also, let's say, legacy businesses that have introduced an e-commerce platform. So this applies really to all facets and all aspects of providing an e-commerce type of solution and selling your goods and services online. So from a overall agenda perspective, if you've participated in any of our webinars before, we tend to start a lot of these with a quick overview discussion of Sales Tax Nexus because it does underpin everything that we do from a sales tax perspective. As we talk through that, we'll kind of put a little bit of a e-commerce spin on it for those remote sellers and those businesses operating in a e-commerce perspective or capacity. Also talk about the taxability of products and services, and then really kind of get into the core aspect of what you guys are here for in terms of navigating some of those specific complexities related to an e-commerce type of business, how we set up a compliance process, and also talk about some of the pitfalls that we've seen along the way. So before we get into the Sales Tax Nexus discussion, we've got a quick poll that I'll have Kate pull up and talk through here real quick with you.
Yep, so our first poll question here is just seeing how you would describe your sales tax knowledge, just so we can see where everyone's at.
Yeah, and as you guys take 30 seconds or so to answer that initial question, if you're not familiar with Tax Connects, I'll give you kind of a quick overview of our business. We're a professional services firm, really kind of a boutique tax advisory, tax consulting type of firm with a very specific focus in the sales tax arena. We've got, I'd say, roughly about 100 people in our business focused in sales tax, and we divide our business into really 2 different practice areas, one being our consulting practice, where we help companies address questions related to where they have nexus, where they have taxable sales, help them with determining their exposure from a sales tax perspective, and also provide audit support. Just a variety of kind of project-oriented work that we help companies with in that consulting division. That's the group here that Jeff heads up. And then we also have a compliance outsourcing service. So if you do have an obligation to collect and remit sales tax in a lot of different states and you choose not to do that work internally, we have an outsourcing group that manages that on behalf of our clients. So it looks like from a polling question perspective, we've got a pretty good mix of entry-level and intermediate people with a handful of advanced sales tax experts on the line, but mostly kind of in that intermediate category. So welcome, everyone, and I'll let Jeff talk about Sales Tax Nexus here.
Thanks, Brian. Kate, As Brian said, I like to start with a nexus discussion just because it's the foundation upon which any of the sales tax decisions need to be made. Without nexus, we don't have a responsibility or a need to address sales tax. Nexus is really just a term used to define a connection between, in this case, a company or an individual with a taxing jurisdiction. So nexus would historically have been defined as a physical connection, and that's what's a little bit unique in regards to economic standards. But for the vast majority of this history of sales tax, we were really dependent upon understanding whether or not a company had physical nexus, whether they had an office, an employee, inventory located within the state. Those were the more common general criteria that qualified somebody to have nexus. And then there were some others that involved solicitation. Maybe you had traveling employees that went into the state to sell on your behalf, or maybe even independent contractors performing services on your behalf in a state. Those also would be examples of physical nexus or physical presence. But really where things really started to change was around 2016. South Dakota legislated an economic nexus standard for their state for sales tax purposes. And as that sort of legislation made its way and got approval, there began to be assertions or assessments, one of which was against Wayfair. And Wayfair decided to challenge the constitutionality of this economic nexus standard. So when we talk about an economic nexus standard, what we're really saying is any derived revenue from that state will, in essence, create nexus for the company making those sales or generating that revenue. And in this particular case, the initial legislation out of South Dakota was anyone generating $100,000 in sales during a calendar or fiscal year and or having 200 transactions within the same 12-month time frame. So Wayfair just went after the state of South Dakota in terms of the constitutionality of an economic nexus standard. In doing so, the Supreme Court in South Dakota actually heard the case and actually ruled in favor of the taxpayer. So Wayfair was a big winner in this regard. However, South Dakota asked the U.S. Supreme Court to hear the case and to make a ruling, and the U.S. Supreme Court agreed to do so. So in April of 2018, U.S. Supreme Court heard arguments from both sides, Wayfair and South Dakota, and in June of 2018, they passed down a decision, a 5-4 decision in favor of South Dakota, thus really making an economic nexus standard constitutional. And as you might have guessed, all of the states were really poised and watching this closely, and some of them had already introduced their own legislation. And as soon as this case was determined, the other states started to release their own legislation or enact their own legislation. And so that sort of took place over about a 3-year span of time in terms of all the states kind of getting their own standards in place. Missouri was kind of the last to come to the table. They enacted their economic nexus standard, and it went into effect January 1 of 2023. So as we sit today, all the states that have a sales tax, including DC, have enacted some form of an economic nexus standard, the majority of which have used this $100,000 threshold within a 12-month period. And when we talk about this threshold, there are variables or variances across the states in terms of what revenue means. And in a lot of cases, I'd say in most cases, the states have identified it as gross receipts. And we would characterize this as gross invoiced revenue. There are some states, however, that have refined their legislation a little bit further to include only taxable receipts, or in some cases they'll refer to it as retail receipts, or even sales of tangible personal property. So there are degrees by which we would evaluate economic nexus state over state. In addition to those definitions for revenue, there also are different revenue thresholds. California and Texas have a $500,000 threshold. Mississippi and Alabama have $250,000 as their threshold. Like any other sales tax scenario, the states don't make it easy for us to just comply across the entire country. What I encourage companies to do is to really just think of it as a $100,000 threshold. Think of that as your bright line test. And when you are watching your business grow, when you hit that 100,000, you got to start asking the question, have I triggered Nexus in any given state? And at that point, you can do a little bit more research and determine whether or not that threshold has been met. Now, the economic Nexus standard, again, is relatively new. It's now getting old at 5 years, but it's relative to the overall history of sales tax, it's relatively new. And it did not do anything to change physical presence standards. So physical Nexus is still a thing. It's still something you have to pay attention to and comply with. But economic Nexus in some ways gave us at least some bright line test that we could use. And in some ways, that made it easier to determine Nexus for some companies. I think overall, it's still complicated. So just think about that $100,000 threshold, and you'll probably be in good shape.
Yeah, Jeff, one thing for the audience to consider is that a lot of you guys are probably using some type of shopping cart platform, and we'll talk about shopping carts here in a little bit. But if you're using like a Shopify, for example, it does a pretty good job of tracking some of these thresholds and some of these number of transactions, revenue, and so forth. And it'll provide you a little bit of guidance as to where you might have already established Nexus. Just be careful in looking at that to ensure that all of your activity is running through that platform, and we'll talk about some more details on this in a little bit in terms of marketplace facilitators and how that factors into the Nexus equation, and of course the physical presence that Jeff had referenced as well. So even though you might have kind of a Nexus map inside of that shopping cart, it may only be giving you just kind of a slice or one perspective on the overall Nexus footprint of the organization.
Good point. Thank you. So now that we've kind of identified the standards for Nexus, and let's assume we have Nexus, that still doesn't mean that we have an obligation to register to comply for sales and use tax purposes in the state. In addition to having Nexus for sales tax purposes, you also need to be engaged in an activity that's subject to sales tax, or at least is within the framework of the sales and use tax laws. Generally speaking, really all of the states that have a sales tax levy that tax on the retail sale of tangible personal property. Many of the states also have started to tax services, but historically services have generally been what we refer to as excluded from tax. When we use the term excluded, we're not saying it's exempt. An exemption would apply where an otherwise taxable item is being used in a capacity or in a situation that allows for it to be exempt. Excluded simply means there was never any intent to tax that service. Our services here in Georgia fall inside that sort of excluded framework. So in Georgia, we are not required to charge and collect sales tax on our services. As Brian described earlier, it's more or less a professional services organization in that regard. There are 5 states that don't have a state-level sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. Alaska does have city-level sales taxes, and we'll talk a little bit about what that means and the term home rule here in the next slide. But when you think about sales tax applicability, you do have to take into consideration what type of customer are you selling to, how is your customer generally going to use the product, and then if you're providing a service, whether or not that service may or may not be taxable. I don't want anyone on this call to be left with the impression that services are are almost always excluded. There are a ton of services that are taxable in many of the states. Telecommunication services are probably the most common that we find a great deal of tax application to. So you do have to be careful, and not only that, but you might be operating in a state today that doesn't tax your specific service, and now you're creating economic nexus in other states where that service might be taxable. So be careful not to apply the same rules that apply in your state to other states. Same would go for some scenarios like sales to government agencies or sales to nonprofits. Depending on the state, a nonprofit or a government agency, they both may be taxable, while in many other states they would qualify as exempt. When we talk about those exemptions, the key difference between an exclusion and an exemption, in addition to the exclusion not being mentioned in the statute, is an exemption typically requires some form of documentation, some type of what we refer to as an exemption certificate, signed and delivered to the vendor from the customer that outlines the exempt status. The last thing that's really difficult or challenging, particularly when it comes to services, is situsing. So now we've got nexus determination having been made, we have a taxability determination having been made, and now we get into the actual transaction, the actual contract, and we have to determine in which state and maybe in which city the transaction is deemed to have occurred. Where did the sale take place? In the case of services, we generally point to the benefit of service. Where was the benefit of service received? And in the case of tangible personal property, we typically look at where title has transferred. Title and possession kind of go hand in hand, but not always are they at the same time. So situsing is critically important when trying to determine what tax to apply for what state and at what rate. So it's just another level of complexity that adds to the bucket. Now, when we talk about remote sellers, there are some new rules that have come about as a result of the economic nexus legislation. And so some of the states have attempted to make it easier for remote sellers to comply. In some cases, their attempts at making it easier only serve to make it more complicated, to be honest with you, for a lot of companies. And the reality is this is still an evolution, and we're seeing even up to this year, we're seeing some states going back, reevaluating their legislation. In some cases, they're removing the 200 transaction threshold. I think a number of states have realized that's not a good measure, not a good bright line test for somebody that's selling $5 components. And so there are some states that have sort of pulled back off of that. I don't think we've seen any recent changes in the revenue thresholds, but I can tell you there were changes over the course of the last 5-7 years, or 5 to 3 years, in terms of states kind of pulling back and reducing the thresholds. So I think there's more change to come, and there'll be some more challenges to come. But just wanted to kind of highlight a few instances where it's important to understand the responsibilities. You know, I mentioned earlier, Alaska, for example, has no state-level sales tax. However, they do have city-level sales taxes. These are what we refer to as home rule jurisdictions. We see home rule jurisdictions primarily in 4 states. That would be Alaska, Alabama, Colorado, and Louisiana. Chicago is also a home rule jurisdiction, so we don't want to leave it out, but it's the only one in Illinois. So in these home rule jurisdictions, they've had to sort of adapt their own sort of program or legislation around an economic nexus standard. And for the most part, what they've done is they've consolidated, they've come together as a coalition and established state-level transaction thresholds or revenue thresholds by which they will assert nexus. So in Colorado, for example, if you've established economic nexus at the state level, you've also established it in each of the home rule cities. So you now have an obligation to comply in each of those. They have their own administration their own filing, their own rates, and their own taxability that doesn't always match up with the state. That's Colorado as an example. The other home rule cities tend to be a little bit closer in line with the states, and I'm speaking of Alabama and Louisiana now. Most of those parishes and Alabama locals do pretty much follow the state level tax treatment for tangible personal property and services. Of course, in Alaska, there is no state tax, so the cities are all kind of independent and kind of do their own thing. And so when Colorado and Alabama and Louisiana and even in Alaska, when they enacted this legislation, they either also enacted some relatively simple filing procedures or at least some consolidated filing options. And in some cases here, the states afforded the remote seller a flat rate. So, for example, in Alabama, you could have 3 to 4 different rates in a specific city when you apply the state level, county level, city level, and maybe there's a district level. And so the state of Alabama said, look, we're just going to apply an 8% rate. If the only nexus you have with the state of Alabama is economic, you will be afforded the opportunity to use a flat rate instead of having to calculate the tax based on each individual jurisdiction. Colorado and Louisiana instituted some consolidated filing and registration options. Colorado is still trying to fix theirs. It's been a debacle to some degree. It's getting better, and the state has sort of come in and said, look, you guys got to fix this. It has to change. It's got to work. And so they're in the process of fixing it. They have been given some deadlines by which to get that met. Louisiana similarly has a consolidated filing option as well. So when you're going in to evaluate your nexus in these states and then you determine your taxability, there will come a time when you have to make a decision about registration. We'll talk about that a little later, but you can start to see that depending on whether you're a remote seller or considered to have economic nexus, or you have a physical presence, you might have a different registration requirement, or at least the type of license you're going to register for might be a little bit different. So just some factors to identify and point out.
And Jeff, I'll just highlight one thing. You kind of said it there at the end, but what is the definition of a remote seller? You may have addressed it earlier and touched upon it just a minute ago, but it's really somebody that otherwise doesn't have a physical presence in the state. So we're really talking about, typically this is applying to an e-commerce type of organization where they don't have a physical presence, but they do meet the economic nexus standard. They're referred to as a remote seller.
Yeah, good point. So we've arrived at sort of the I guess the pinnacle of remote selling in the U.S. at least, and I'm referring to marketplace facilitators, Amazon, eBay, Etsy. This concept of a marketplace facilitator has probably driven the desire, the need, and the requirement of having an economic nexus standard. So they weren't going to be left out in all of this. And essentially what all of the states have done is they've not only established an economic nexus standard and registration filing requirement for remote sellers, they've done the same thing for marketplace facilitators. And basically the rules are very similar. Meeting an economic nexus or a revenue threshold in any given state by one of these type of facilitators is going to establish nexus, and the facilitator themselves is going to have to register and charge and collect sales tax on transactions that flow through their process. Now, when we talk about marketplace facilitators, it's important to distinguish between a marketplace facilitator and there are other businesses like a Shopify. There are other types of platforms out there that are leveraged by remote sellers that might not meet the definition of a marketplace facilitator. A marketplace facilitator has to have a few key components. It's got to be a platform that allows third-party sellers to facilitate retail sales, and then it has to also collect payment or process payment on behalf of that transaction. And that's a key factor, because I don't think Shopify today processes payment. I think that's a separate process within that framework. So that's sort of the way we think about or define a marketplace facilitator. And that definition is pretty consistent across all the states. While they are required to charge sales tax, there are some circumstances where things can be a little bit challenging. And it has to do with some of the the local applicability rules in some of the states. So there can be some unique requirements if you are a marketplace facilitator or intend to be one. Just be aware that there are some nuances out there that you want to be aware of. And then lastly, something Brian brought up earlier, is you're evaluating Nexus and you are starting as a remote seller. Maybe you're a remote seller and you have historically been a brick and mortar seller, but you've got a dynamic sales channel. You've got sales through Shopify, you've got sales through Amazon, you've got sales on your own website, you've got sales at your storefront. Those are multiple facets that need to be consolidated typically when determining your Nexus threshold. So if you're selling $75,000 worth of product through Amazon in a state, and you've got another $35,000 through your Shopify platform, you likely have exceeded the Nexus threshold. You're now beyond the $100,000 threshold, depending on the state. So not all the states operate the same way in this regard. Again, there's always nuances, or as I like to call them, headaches. But generally speaking, I think everybody should just be thinking about that $100,000 threshold and thinking about gross receipts, all of your receipts across all channels.
All right, so Kate, I think we've got the next polling question here.
Yep, so our next polling question is going to be, when thinking about sales tax, what is your biggest concern? And we'll give you a minute to answer that.
Yeah, and while you guys are answering that question, we do have a question from the audience, and I'll pose it to you, Jeff. It's really focused on the situsing question. So when we talked about situsing, did I miss if it's an online sale? If the selling company is located in Texas, but the purchaser uses their computer in Nebraska to make a purchase, is the situs Nebraska or Texas?
So I'll answer it in two scenarios. Let's just assume in this example it's a service, or maybe it's software. Might be an electronically transferred product, or it could be software as a service, a cloud-based application. So in that particular case, we would presume for that service the customer to be based in Nebraska, and the situs of that transaction would be Nebraska. We would assume that the benefit of use is in Nebraska, in the absence of any other evidence to the contrary. If we're talking about tangible personal property, then it will depend on how the product's being delivered or shipped. The overwhelming majority of transactions in the U.S., volume-wise at least, are shipped via common carrier and FOB destination, meaning the title is essentially deemed to have transferred when the customer receives possession of the product. So again, in that, if we assume a common carrier shipment and we assume FOB destination, then we would assume even in the tangible sense, this would be sitused in Nebraska as well. Now, just to give you an example of what might not be sitused in Nebraska, it could be that I am buying a gift for my mom who lives in Oklahoma, and I'm going to have that vendor ship it directly to Oklahoma. And depending on whether that vendor has Nexus in Oklahoma and has a responsibility to charge sales tax, they would end up charging me sales tax on that shipment to Oklahoma. And Oklahoma would become the situs of that transaction. And another scenario that's more uncommon but is fairly prevalent in big business, where you have big products that are being shipped, big pieces of equipment, it's not uncommon for the seller to deliver at FOB origin, meaning the customer is going to coordinate the transportation, and they're going to actually take possession either through themselves or through an agent at the shipping point, at the distributor's location. And at that point, if it's in Texas, Texas would be the situsing for that sales tax treatment. Now, there's all kinds of other rules that might apply, exporting out of Texas or exporting out of the country. A lot of nuances that you might need to explore, but those are some of the general guidelines.
Yeah, I think that's helpful, and likely, I think most of the people that I would assume that are on the presentation are probably selling some kind of tangible personal property and having it shipped to a location, and we would cite us out to wherever it's being shipped to, basically.
Yeah, that's 95% of the time. That's what happens.
Yeah, so in terms of the audience here, in terms of their concerns, what they're focused on, not surprising, nexus and taxability are the key factors, a little bit more heavily weighted to taxability than what we normally see, which kind of segues pretty nicely, I think, into this the next slide here as we talk about, how do we actually manage this process prospectively. And I think I jumped one step too far there, but when we start looking at the different shopping carts that are available, there are a significant number of technology platforms that you can utilize. Here, at least in terms of our clients, we tend to see either Shopify or BigCommerce as kind of the main shopping cart platforms that companies utilize. Again, there's a lot of other options. We're not necessarily endorsing either of these specifically, but just tend to have more familiarity with these platforms themselves. So when you start looking at, how do we apply tax within the shopping cart, Shopify tends to have several different options here. Earlier this year, I think it was in January, they introduced what's referred to as Shopify Tax. And that Shopify Tax platform has some very specific taxability rules based on the type of products that you might be selling within that shopping cart. Outside of that Shopify Tax, and I'll talk about that in a little bit more detail here shortly, but outside of that Shopify Tax, they do have some fairly rudimentary capabilities to apply tax on the transactions with the assumption that essentially everything that you're selling is tangible personal property and is subject to the sales tax rate. So for some merchants, that might be a very simple answer, depending on what you're selling. If it's taxable in every state and all we need to do is apply a specific tax rate to it, even the most basic, truly the basic version of Shopify can apply sales tax to those transactions. When you look at that Shopify tax platform, there is an additional fee associated with that. It comes with a set of tax codes or product codes. And what you end up doing is taking each of the products that you're selling within that shopping cart and you map it to the specific product code within Shopify Tax. And the last time I looked, my guess is maybe a couple thousand different product codes available, anywhere from, children's clothing to craft supplies to shoes, a lot of the kind of core tangible personal property that a lot of merchants sell, they have tax codes specific to those items. And the advantage of utilizing that type of, let's call it sophistication from a taxability perspective, is when you start looking at even something that might be as simple as clothing, there are different exemptions and different taxability rules from state to state. And when a customer is checking out or is making some type of order within the shopping cart, based on the address, which is going to be the ship to address, that's going to be the citing point. So based on that ship to address and based on that product code, it's going to know the correct taxability of that item and apply the correct tax rate to that item so the correct tax gets charged in that platform. Now, there are some limitations to that Shopify Tax set of product codes. If whatever you're selling doesn't map directly into one of their available codes, then you're going to have to go with some type of third-party plugin software. We've got Avalara here mentioned as really the only option for a real-time integration with Shopify Plus. I believe it's still true and accurate that you would have to upgrade to the Shopify Plus platform to get access to that Avalara AvaTax tax calculation function. So there's really three different options, from a Shopify perspective, whether it's AvaTax or the Shopify tax, or just use the standard, let's apply a tax rate to everything we're selling, kind of basic version. When you look at BigCommerce, it tends to be a little bit more open in terms of the ability to integrate taxing engines or plug-in solutions into BigCommerce. It has, I think, less native functionality in terms of applying tax correctly, and really relies upon the plug-in options, whether that be an Avalara or a Thomson Reuters or a Vertex. Because it's more open, it allows the integration of different taxing systems into their shopping cart rather than being single-threaded solely through Avalara, like the Shopify Plus platform is itself. And similar on the BigCommerce side, those taxing engines they're going to do the same type of thing in terms of determining the applicability of sales tax and calculating the sales tax within the shopping cart, within that transaction. The key there, and it's referenced as the last bullet point at the bottom of the page, and that's in the tax mapping. And what we're referring to there is when you look at the product codes, whether it's in that Shopify tax or whether it's in a third-party plugin, it's to make sure that you get a one-to-one match or a one-to-one map of what you're selling into that specific product code. So outside of calculating the tax, in the shopping cart itself, there's more here from a compliance perspective in terms of registering and filing ongoing as well. And of course, also, managing and recognizing when your Nexus footprint changes or when your Nexus footprint expands. But if we start looking at, from a registration perspective, there's a few considerations here. The key pieces that I point out to individuals is this responsible party law aspect from a state sales tax perspective, meaning the states want a specific person or individual that they can hold accountable for sales tax within their business. Tends to be an owner, a corporate officer, someone that has influence over the financial decisions of the organization. And what ends up happening is if the company itself is not complying from a sales tax perspective, then the states can hold that individual, that corporate officer, personally responsible for the sales tax. You might question or wonder if an LLC protects you in this scenario. It does not for sales tax purposes. It may for other tax types, but states are still able to come after corporate officers for sales tax due within the company, even in an LLC. Another aspect that we sometimes run into may not affect a lot of you on the call, but if you're an international business selling into the U.S., I'm not aware of any option of getting a sales tax registration completed and therefore getting your sales tax ID granted. I'm not aware of any option unless you have a U.S. federal EIN. So it becomes a little bit challenging sometimes for those international businesses that do want to comply with the U.S. sales tax rules. We recommend, and they need the FEIN in order to get the sales tax IDs assigned to them at the state level. It also does become a little bit challenging to get the sales tax ID assigned for a foreign-based business, even with that EIN number, because the states are generally also looking for a U.S. Social Security number. So if that corporate officer is not based in the U.S., there are still opportunities and options to get the sales tax ID assigned. It's just a little bit more complicated if you don't have a U.S.-based officer with a SOC number. I'll also reiterate what Jeff had mentioned before in terms of the registration process. Knowing what type of registration you're pursuing is important. So we talked a good bit about these remote sellers. There are separate registration requirements and separate returns that the remote sellers can take advantage of, specifically the Alabama and Louisiana scenarios that we talked about earlier. So you want to make sure you register for the right tax type. So once we've got the registrations in place, the state is going to assign us a sales tax ID, which now grants us the right to collect the sales tax. At the same time, they're going to assign a monthly filing frequency, or perhaps a quarterly. They're going to assign a filing frequency. We don't know if it's going to be monthly or quarterly or annual, but based on what they assign, now we have to file that return periodically. And depending on which channels and platforms you're selling through, gathering the data to file these returns could be quite simple. It could be very difficult. If you look at a scenario of selling on a marketplace facilitator platform, selling through a shopping cart on your own website, maybe you have invoices that you send out through your typical accounting invoicing process. You've got all this data that needs to come together and be consolidated to file the return. So just keep that in mind. Even on the marketplace, there are some states that want us to report the gross sales through the marketplace, even though the sales tax has already been taken care of by the marketplace facilitator. We still want to make sure we're looking at that revenue not only from a economic nexus perspective, but also adding that to the sales tax returns where it's necessary. The tax calendar that we're referencing is essentially that listing of where you're registered and those filing frequencies, and that could change over time. So a state may set you up as a quarterly filing frequency and kind of flip the switch to monthly at some point. So you got to keep up with that and make sure you're managing and filing those sales tax returns based on whatever that filing frequency is. Jeff had a good description earlier about some of the local requirements in Alaska, Alabama, Colorado, and Louisiana. So there could be, depending on how you sell and in which of those states, you could have some local filing obligations. We mentioned Alabama and Louisiana have some nice remote seller type of consolidated filings, which make it a little bit simple. Maybe the only thing that the states have ever done to make sales tax simple. It seems to work pretty well. Colorado is trying to emulate that, but they're a little bit behind schedule. I say behind schedule. They're behind Alabama and Alabama and Louisiana in terms of their ability to kind of consolidate and centralize that remote seller return. So we end up in Colorado in a real difficult spot where we have some of the home rule jurisdictions can be filed on a consolidated return, while other home rule jurisdictions don't yet participate in the centralized return. So we still have to file local returns for certain home rule jurisdictions in Colorado. And then we mentioned Alaska. I think Alaska is probably more similar to Colorado, where they're not quite all on a centralized platform yet. So you end up in the hybrid mode of filing a consolidated return for certain Alaska locals and then filing direct with other Alaska locals. So it's kind of a mess as well. Looking at further into the compliance process, you've also got to take into account notices. Sometimes those notices might be a change in filing frequency. Sometimes it might be some type of question on a return that you have to answer. Those notices don't always get mailed to you. A lot of times they're posted in the e-file accounts. I do think most of the state e-file accounts do at least send you an email that notifies you that there is a notice in the e-file account, but it requires someone in your organization to log into that e-file account, to look at that notice and make a decision as to what to do with it. And we see this getting neglected with a lot of the kind of the quote-unquote auto file or automated sales tax solutions, where these notices kind of stack up in the e-file account and nobody's really paying attention to them. So it's just good to have a process to make sure you're looking at those. Now, a couple of things that we've run into in terms of pitfalls in talking with and working with e-commerce companies. The biggest one that I see is when we run into some of these plug-in solutions, let's call them, that operate outside of or after the transaction has been processed. And what I mean by that is within your shopping cart, we talked about the calculation aspect of the tax before. And so there are options in a plug-in capacity to charge the sales tax in the shopping cart, apply it within the shopping cart, charge the applicable tax within the shopping cart, collect the money from the client, and that works well inside the shopping cart. When we get to file or start looking at how do we file returns, we see that there are other technology solutions that will, quote unquote, plug into the shopping cart. And what it does is rather than take the sales tax data that's already been charged and collect it, they're taking all the transactions out of the shopping cart, recalculating how much sales tax they think is due, and then reporting that sales tax that they calculated. And what ends up happening is there's a completely different sales tax number between what was charged and collected in the shopping cart and what was actually reported by these other technology platforms. Hopefully that description makes sense, but you need to be careful of some of these plug-in options that are after the transaction has happened and they're pulling the data out of your system, recalculating the data, and then filing whatever they calculate. It's going to be a reconciliation issue at best and a reconciliation nightmare for you at worst if you rely on that type of solution. Also talked a little bit about some of the automated type of solutions from a sales tax reporting perspective. If you do find one that, let's just say Avalara, which is in the shopping cart and is calculating the tax within the shopping cart, if you subscribe to their auto file solution, that's what it is. It's auto files. But who do you call with questions? How do you get notices addressed? Those auto file solutions are also only reporting the taxes that are collected within the shopping cart. So how does a Washington B&O return get filed? How does a Colorado retail delivery fee get filed? Did they repeal that yet, or is that Colorado retail delivery fee?
They've changed the threshold that requires it.
Oh, okay.
But it's kind of repealed.
Yeah, they raised the threshold.
Raised the threshold.
Got it. But those auto file solutions aren't going to file that Colorado retail delivery fee because it's just not part of their makeup. So there's some holes in those auto file solutions that you just have to be aware of. And the last one, and it's not on here, but I wanted to reiterate something that we said earlier. A pitfall is relying on the Nexus map or the Nexus illustration within your shopping cart and solely relying on that as to where you need to register and file. Because hopefully we've illustrated during this conversation that you need to factor in all of these other sales platforms, the marketplace facilitators, the invoicing platforms. All of that has to flow together to give you a perspective as to where you have Nexus. So with that, I think we've got the last polling question, and then we've got a few minutes for some questions as well.
This is just to see if you're interested in learning more about us. We'd love to have someone reach out and talk to you more about our services. and we'll give you a little minute to answer that.
Yeah, no, I've got one question here in queue. If you have questions, please go ahead and submit those because we'll be wrapping up here shortly if we don't get any additional questions. So Jeff, if we charge sales tax up front, but then we don't have nexus for that state by the end of the year, do we refund that sales tax portion back to the purchase, or do we keep it as miscellaneous income?
I'll answer it in reverse. You don't keep it as miscellaneous income under any circumstances. Any tax that you might collect is, for the most part, you should think of it as a trust fund. It's not always going to be a trust fund. Sometimes it's a gross receipts tax. But in essence, you're acting as an agent on behalf of the government to collect that money. So under no circumstances would you absorb that into revenue. However, we do have clients from time to time that maybe they mistakenly charge and collect tax in a jurisdiction they had no intention of doing so. They don't have nexus. They don't plan to register. In those circumstances, we would encourage them to refund and return that tax to the customer sooner than later. Would not say it would be a good idea to charge tax during the first part of the year, anticipating that you might get to a place where you're going to register and comply. But later in the year, you decide, no, we didn't really meet the threshold, we don't really intend to register, and then go back and refund the customer. I wouldn't advise that. It is maybe, and there could be an element to this question that I want to clarify. When we talk about these thresholds, anything that happens up to that threshold, in other words, the first $100,000 are not taxable if your only nexus creating activity is economic in nature. So it would not be advisable to start charging tax until the sale after you've hit that $100,000 threshold. And in some of those states, there's actually some leniency beyond that. They'll give you 60 to 90 days in which to get registered and start to comply. So you may end up even exceeding $100,000 under those conditions. So hopefully that helps a little bit with that question.
Yeah, and I'll add a follow-up question to that as well, because as you were describing that, this is usually the next question that we get asked, and it's, so if I've established nexus, or if I've exceeded that economic nexus threshold in 2023 and I start charging tax, do I need to reevaluate that in 2024? Did the clock kind of reset, or what am I supposed to do there?
Yeah, there can be some variance across the states in this regard. You do have the ability to evaluate your nexus on an annual basis, and to the extent that you no longer have nexus, you have the authority to close your account and stop charging and collecting tax prospectively. I'd be careful with that approach only from the standpoint that if your business is going to have cycles where in some states for some years you'll have heavier than usual activity, and then other years you may have a little lighter, but it'll cycle back and you'll have heavier again. I wouldn't want to be in a position where I was opening and then closing and then opening my account. The reason being is I'd like to have a fluid statute of limitations running in my favor. The statute of limitations basically says that as long as I'm filing on a prescribed filing timeline and I'm always on time, I get the advantage of a limited ability for the state to audit my books and records. Usually that's 36 months. So if I've been operating for 7 years and I've been filing, maybe I've been filing 0 returns the whole time, but I should have been charging tax on this transaction, and I never did. If the state does audit me 7 years into that sort of scenario, they're only going to be able to go back 3, maybe 4 years. There's a few that go back a little further than that. But because I've been registered and filing, I've sort of protected myself for some portion of that risk and exposure. But everybody's situation is a little different. It's a tough question to answer for everybody, just because everybody's circumstances and desires are a little bit different. So just know there's some options there.
All right. Thanks for that clarification, Jeff. And that brings us to the end of the discussion here today. Thank you, everyone, for joining us. and hopefully we'll hear from you again in the near future. Have a great day.
Thanks, everybody.